So the fund, we have three primary investment objectives. The first is consistent and well above average distribution yield of the fund itself. This is an income fund. It is a replacement, believe it or not, for fixed income. We are solving the fixed income dilemma. We want to deliver a yield that is right now much, much higher than fixed income. The distribution yield out of the fund is well over 3%. We also want dividend per share or distributions per share of the fund to grow through time. The key again is we want this dividends or income to grow faster than the inflation rate. If it's growing faster than the inflation rate, then the purchasing power of that income will be maintained because it's better than inflation throughout a person's life. This is a forever strategy as a result. The idea is buy it, live off of it, and your income will go up at least as fast as inflation, and ultimately capital will go up with growth. So our third objective, of course, is long-term appreciation of capital. We believe that, and we do this in order. So the investment objectives are stated in the order of priority. Have to have a decent yield. Never have we been below 3% yield at the fund level. Typically, our average dividend yields are in the high threes. We have to have growth of income is the next highest priority. And we actually believe that the third objective, long-term capital appreciation, is a consequence of delivering the first two objectives. If we deliver a decent yield that grows nicely through time, capital appreciation is a consequence of this package together. I don't have to focus on looking for the highest returning stocks. All I have to focus on is good yield that grows through time. Then capital appreciation mathematically is going to be delivered sooner or later. If we get the dividends right, we will get the share prices right. And this is kind of the proof in the pudding, if you will. This is Series F distributions out of the fund on a calendar year basis from the inception of the fund, which was back in early 2015, until now. And what you see here is every year, you're seeing this escalating distribution per share at the fund level. Exactly what we wanted to do. And you'll notice that the current trailing distribution yield, despite being up over 40% in the last 12 months, this trailing distribution yield is 3.3% on an annualized basis. And you'll see that since inception, our distribution has grown by 8% per annum. Inflation, 2-3. We are maintaining an investor's lifestyle, and we'll be able to do it forever. And in fact, they're getting a raise every year, even after taking off inflation. A significant raise, a 5% raise above a 3% inflation rate. So that's the way we look at the world. We're trying to deliver investors an ever increasing distribution per share, and hopefully that is significantly ahead of the inflation rate. Therefore, the clients are getting a raise every year. Their purchasing power, their ability to spend money goes up every single year. You'll notice the little dip last year. We had what I call the Dividend Armageddon during COVID. Fully 20%, 1 in 5 of all large cap North American stocks actually cut, suspended, or eliminated their dividend last year. We are seeing dividend growth reaccelerate at a very fast rate right now. So what you see right now is 2021's distribution is annualizing right now through the end of August we're back on track. You can almost ignore 2020, and we are well ahead of our distribution that we paid out on 2019. Bang on mandate. A couple more points on distributions. We pay monthly, and we pay only the amount of income that the fund receives. Every penny that the fund, after withholding taxes, receives in income from dividends around the world, every single month I go to the penny, and that's what we distribute. So every month, the distribution does change because it's exact to what we received. But what you see over time is this growth. Okay? What this is then is a real measure of distributions. It's a real measure of true income generation by the stocks that we hold in the portfolio. This is very unlike most dividend funds in this country that pay out a fixed distribution yield, typically set much higher than they're actually earning. So this is true income. As a result, there's no NAV grind. There's no NAV per unit grind like you would see in a fund that say earns 3.5 but's paying 5. There you're driving down the NAV because you're not paying out income, you're paying out income plus part of the original capital that the person put in. Currently, we also have a very unique situation in the fact that this fund is a corporate class fund. The corporate class funds, as you know, can share gains and losses from other corporate classes. We took over this fund, this corporate class, from a flow-through rollover fund, which was kind enough for us to generate a substantial tax loss carry forward, both in capital gains and in income. And if you think about what I do as a global dividend investor, the majority of my dividends come from the US. More than 50% come from the US. And as you know, US dividends are treated as income in Canada, as opposed to capital gains, of course, or dividend credit eligible Canadian dividends. So it's treated as income, but we have all this income losses. So we're able to net those against each other every year. And in fact, since inception of the fund 6 years ago, no investor T5 slip has shown any income gains, and in fact, no capital gains either, because we also have $10 million of capital losses carry forward as well in the fund. So despite going up and paying out all these distributions, mainly generated from the US, no investor has received income or capital gains on their T5s. They've only received Canadian credit eligible dividends. We do distribute through the full system Canadian dividends because they attract a tax credit and because it's a corporate class fund. The portfolio, I list the top 30 on this slide. I won't go through them, of course, but I'll maybe talk about the averages. So it is a large cap strategy. We have $115 billion average market cap. We go down to $1-2 billion in size. So you can see in here, Fiera Capital's the holding in the fund. It's only a little over $1 billion. Acon here in Canada is also a little over $1 billion in size. So we do go down to $1 to $2 billion, but on average, we are a very large cap fund. The average dividend yield in the strategy of the stocks that we hold before withholding taxes is 3.9%. So very high yield. But interestingly, and this is the key, you will not find this anywhere else in Canada, the average dividend growth rate, even though we've come out of Dividend Armageddon, is 20.5% year over year on a 1-year basis. And in fact, it's 17.4% per annum. This isn't 5-year number. This is a per annum over 5 years. Our overall portfolio weighted 5-year dividend per share growth rate is actually 17%. GDI score comes in at a solid 29. And what you see here is it's an incredibly inexpensive portfolio. The average PE of our portfolio stocks is 12. The average price to cash flow is 8 on a forward-looking basis. That gives us incredible dividend coverage as well. We have 2 to 3 times coverage on our dividends. So high degree of dividend safety, and yet a nicely cheap portfolio with an incredibly high active share. 93%. We're 93% different than the Morgan Stanley World Index. Only 7% of our positions overlap. So as a result, the fund is a big time diversifier to your other holdings in the portfolio. Okay. I have portfolio exposures here. I won't bore you with them right now. Style, as I already indicated, we are heavy duty, large cap value. We're one of the few hardcore value strategies in the country, despite being such high yield. And it's because of our process. It's because of this idea of high yield with high dividend safety, with good growth. And what you do see is exactly that on our portfolio financials. Dividend yield is, what's that? 2.5, 3 times what the world index is. PE ratio is less than half. This is from Morningstar. All our other valuation characteristics are a fraction of the global index, but we don't give up growth because it's DGARP. We need forward-looking growth to keep up the dividend growth rate. So cheap portfolio, high yield, without sacrificing growth. And what you see is no style drift on those key characteristics. This is a 5-year style graph for Morningstar. Value, we're always high value through thick and thin. And we're always high yield through thick and thin. No style drift.